Let me ask you something. You started your LLC, you built your online store. Customers are buying from you in California, Texas, Florida, all across the country. Business is growing, life is good, and then a letter shows up. It's from the state of Colorado, or Washington, or South Carolina, a state where you have never set foot, never rented an office, never hired a single employee. And this letter says, you owe us sales tax. If that scenario sounds like a nightmare, it is. And right now, thousands of online business owners are walking straight into it without even knowing it. After the 2018 Supreme Court ruling in South Dakota Wayfair, the entire rulebook for sales tax in America was rewritten. And if you run an LLC that sells products or services online, this ruling directly affects you. Today I'm going to break down exactly what Economic Nexus is, which states can legally come after you, what the thresholds are that trigger your tax obligation, and most importantly, how to protect yourself before it becomes a problem. Stay with me, because by the end of this video, you'll know more about sales tax compliance than 90% of online business owners out there. What is sales tax nexus? First, let's start with the basics. What is nexus? In tax law, nexus simply means a connection between your business and a state that legally requires you to collect and remit sales tax to that state. Historically, the rule was simple. Physical presence. If you had an office, a warehouse, employees, or inventory in a state, you had nexus there. You owed sales tax there. That meant that as an online seller operating from your home in Ohio, you only had nexus in Ohio. Other states, not your problem. Simple, clean, easy. But then came e-commerce, Amazon, Shopify stores, digital products, dropshipping, and states started watching billions of dollars in sales flow through their borders every year without collecting a single penny in sales tax. States were losing money, a lot of money, and in 2018, the Supreme Court handed them the weapon they were looking for. The Wayfair ruling, how everything changed. The case was South Dakota with Wayfair. And if you run an online business, this is the most important Supreme Court decision you probably never heard of. South Dakota passed a law saying if you sell more than $100,000 worth of goods or complete more than 200 separate transactions into our state in a year, you have nexus. You must collect our sales tax, period. Even if you've never touched South Dakota soil, Wayfair, the massive online retailer, challenged it, and the Supreme Court said South Dakota will. And just like that, Economic Nexus was born. Within months, virtually every state in the US followed with their own Economic Nexus laws. Same concept, different thresholds. And here's what makes this dangerous for LLC owners. The threshold clock resets every year. You might have been fined in 2023, but if your business grew in 2024, you could now owe tax in states you never even thought about. State thresholds. What triggers your liability? Now let's talk numbers, because this is where most entrepreneurs get tripped up. The most common threshold across states is $100,000 in sales or 200 transactions into that state within a calendar year. But not all states follow the same rule. Here's what you need to know. States like California, Texas, and New York use the $500,000 sales threshold, giving you more room before you're on the hook. States like South Dakota, Colorado, and Pennsylvania, they're aggressive. Hit $100,000 in sales or just 200 transactions and you're in. Some states have eliminated the transaction count entirely and only use the dollar threshold. Others still use both. And here's a kicker. Digital products and services are included in most states. So if you're selling online courses, SaaS subscriptions, ebooks, consulting, you are not off the hook. Now I know what you're thinking. How am I supposed to track all of this? You're not supposed to do it manually, and I'll show you exactly how to handle this in just a moment. But first, let me talk about the one mistake that gets LLC owners into real trouble. Assuming your LLC's home state is the only state that matters. It's not. The moment you cross those thresholds in another state, that state's rules apply to you. Your LLC registration means nothing to them. How to stay compliant. Practical steps. Okay, here's the part you actually need. What do you do about this? Step 1. Know your sales data. Pull your transaction reports broken down by state. Most e-commerce platforms, Shopify, WooCommerce, Amazon, let you do this. You need to know exactly how much you've sold in every state and how many transactions you've made there. Step 2. Register in states where you've hit the threshold. Once you cross a state's economic nexus threshold, you're required to register for a sales tax permit in that state and begin collecting. Selling without a permit after crossing the threshold, that's where the penalties come in. Step 3. Use automated sales tax software. Use automated sales tax. Tools like TaxJar or Avalara can automatically calculate and even file your sales tax across multiple states. This is non-negotiable for any serious e-commerce business. Step 4. Get your LLC structure right. This is where your foundation matters. If your LLC isn't set up correctly, with the right resident and compliance tracking in place, you're flying blind. Services like No Space Registered Agent are excellent for this. They provide rock-solid registered agent service across all 50 states, keep your privacy protected, and flag compliance requirements so nothing slips through the cracks. If you're just starting out and want a simple guided setup, Zen Business and Inc. Authority are both beginner-friendly platforms that walk you through formation with compliance built in. For the legal side, understanding your obligations, drafting the right documents, having an attorney on call, Rocket Lawyer, and LegalZoom are platforms I'd recommend keeping in your toolkit. And if your business is scaling fast and compliance is becoming a full-time concern, Harvard Compliance specializes in exactly this: multi-state registration, sales tax compliance, and keeping your business legally clean as it grows. The right LLC setup from day one. Here's the truth that most people miss. Sales tax compliance starts at the business formation stage, not after you're already generating revenue. When you form your LLC, where you register matters. Who your registered agent is matters. Whether you're operating agreement accounts for multi-state activity matters. Platforms like Tailor Brands let you form your LLC and build your brand identity in one place, which is great for entrepreneurs who want everything streamlined from the start. Source filings is another option if you want fast, affordable formation with none of the legal headaches. And if you want tools built specifically for startup operations and workflows, Brizy offers smart business solutions designed for growing companies that need structure from day one. The point is this: the right tools and the right setup from the beginning will save you from 5-figure tax surprises later. If this video helped you, hit that like button. It tells me to make more content like this. Subscribe if you want weekly videos on LLCs, legal strategies, and building your business the right way.